Hey everyone, it's Marcel, the Butcher of Wall Street. We've got some hot news right now. A United States bank has just been taken over by the government. We are now seeing massive defaults with what started with Silvergate Bank has now turned into Silicon Valley. On March 8th, 2023, Silvergate Capital announced that it was ending operations and it liquidated Silvergate Bank. Obviously, it sent its stock price plummeting after several months spiral for Silvergate Bank, which was extremely overexposed to cryptocurrencies. Just one day later, March 9th, Silicon Valley Bank informed some clients that wire transfers would be delayed. Their phone lines were no longer accessible, and people were having difficulty logging in to their website to make transfers. Meanwhile, Silicon Valley Bank competitors like JP Morgan sought to convince SVB customers to move their funds from Silicon Valley to JP Morgan, of course. And this Friday morning, trading in Silicon Valley Bank was halted in pre-market as a classic bank run unfolds. The entire banking sector has been down big time today as these overnight deposits have just been waltzing out the door, rolling into higher options, and everything has been squeezing bank profit margins and increasing their losses. As you can see here, just yesterday, Silicon Valley Bank was trading at $108 a share. A few days prior, they were trading at $200 a share. And as of pre-market today, they are down to $39.40 a share. So there is no longer any trading going on whatsoever in Silicon Valley Bank. And today, SIVB, Silicon Valley Bank, was closed by the California Department of Financial Protection and Innovation. And they appointed the FDIC, the Federal Deposit Insurance Corporation, as the receiver. To protect insured depositors, the FDIC created the Deposit Insurance National Bank of Santa Clara, DINB. And at the time of closing, the FDIC, as the receiver, immediately transferred to the DINB all insured deposits of Silicon Valley Bank. But this is nowhere near as good as it sounds. The FDIC states that all insured depositors will have full access to their insured deposits no later than Monday morning, March 13th of 2023, and that the FDIC will pay these uninsured depositors an advance dividend within the next week. They state that they will receive a receivership certificate for the remaining amount of their uninsured funds, and as the FDIC sells the assets of Silicon Valley Bank, future dividend payments may be made to uninsured depositors. This was not a small bank. This was the second largest collapse, the second largest bank failure in United States history after Washington Mutual. Washington Mutual was the United States' largest savings and loans association until their collapse in 2008. And on Thursday, September 25th of 2008, the United States Office of Thrift Supervision seized Washington Mutual's banking operations and placed it into receivership with the FDIC. They ceased operations the following day, September 26th. Now, the issue with SIVB is that they claimed just yesterday, or 2 days ago, to have $180 billion of available liquidity in a presentation. 48 hours later, they have been seized by the FDIC. If the FDIC can't find a buyer by Monday, and uninsured depositors are going to need to take a huge discount on their deposits. This is going to be an insane situation. Minimum 20% cash losses are highly likely to hundreds, if not more, publicly traded companies that keep all their cash in SIVB. Now, some people have done the math on this already. And to give a sense of why a bank run is such a huge issue for a commercial bank like SVB, At a typical regional bank, most depositors are from retail clients. So even if there's a failure, most people will get their reimbursement by the FDIC up to $250,000. But at SVB, Silicon Valley, 93% of their depositors are large institutions. That means that $161 billion out of the $180 billion are uninsured. Think about that for a second. $161 billion out of the $180 billion at SVB are uninsured per a recent regulatory filing, meaning that the psychology to withdraw deposits, if people feel something is going wrong, will be that much more compelling. 93% of all of their deposits are uninsured. And as you can see here, Washington Mutual in 2008 had $307 billion in assets at the time of their failure. And now we've got Silicon Valley Bank out of Santa Clara, California, with $209 billion in assets. This is an absolutely massive bank. And that's not all. Check out what Unusual Whale said on Twitter. They've got proof here that Gregory W. Becker, the CEO of SIVB, sold $3,570,000 worth of stock in the last 2 weeks. This is a criminal act, considering the CEO most likely knows exactly what's going on with his bank at SIVB. And again, this is the second largest bank in the history of the United States to collapse. And guess what our friend Jim Cramer said a month ago? 1 month ago, Jim Cramer urged investors to buy Silver Bank, SIVB. Today, the bank was obviously closed and taken over by the FDIC. Check this out.
The ninth best performer year to date is SVB Financial, don't yawn. This company's a merchant bank with a deposit base that Wall Street had been mistakenly concerned about. SVB is the old Silicon Valley Bank. Recently bought one of our favorite research firms, Nathanson, and it's become less dependent upon private equity and venture capitalist offerings. Wait a second. Those dried up last year, they could come back. Yeah, some of them come back here, but the stock directly affects an oversold position. Stock was the fourth worst performer in 2022. I think the fears were not justified, and it's a very compelling situation. Hey, by the way, long-term private equity and venture capital, they're not going away. Being the banker to these immense pools of capital has always been a very good business. Stock's still cheap. Now, you have to remember that a stock that falls 66%, like SVB Financial did last year, it takes it a lot more to recover. After losing 2/3 of your value, you need a 200% gain to get back to even. This is arithmetic. Some people call it geometry. So you could argue SVB's nearly 40% rally this year is barely a drop in the bucket. And that's how I want you to think it. I think it's also a good example of why these bounce back moves might be far from over. These stocks could have more room to run, especially if you think they were driven down to artificially low levels by tax loss selling, artificial dumping, like we saw.
As you can see, Jim Cramer, as usual, pumping the stocks that are about to do the worst. He said SVB was a huge buy at $320 a share. Today, it's trading at $39.40 a share, has been taken over by the FDIC, and most likely $160 billion out of $180 billion of their deposits are not covered under the FDIC insurance. At the time of closing, the amount of deposits in excess of the insurance limits was undetermined. But this $161 billion, if correct, per a recent regulatory filing, means that 93% are not going to be insured whatsoever. Think about the implications to all the other corporations that bank at this massive institution, the world's second largest bank to collapse in the United States, obviously, because most of the bank runs happen in the United States. And as you can see here, these are the United States bank derivatives. And of course, leading the charts, JP Morgan, Goldman, Citibank, Bank of America, and Wells Fargo. with the largest notional derivatives value here, and not even value. That's more so, liabilities, because these are almost a vast number of liabilities. And Silicon Valley Bank ranked number 33, and they had $27,682,000,000 in total notional derivatives value. In a hearing today before the United States House Ways and Means Committee, Treasury Secretary Janet Yellen said that the department is monitoring multiple banks amidst issues at Silverbank. She said, quote, "There are recent developments that concern a few banks that I'm monitoring very carefully, and when banks experience financial losses, it is and should be a matter of discussion." Matter of concern, she said. Not a discussion, concern. Additionally, Reuters is reporting that Silverbank told its employees in a memo today that they should work from home until further notice, stating, quote, "SVB is undergoing a series of conversations that have not been concluded yet to determine the next steps for the company," end quote. I think we all know what that means, ladies and gentlemen. I'd just like to say a quick shout out. Thank you guys to Grandpa Barney and Eagle Eye Productions. Appreciate your support of the channel. So SVB's talks to sell itself obviously did not go anywhere since it was halted this morning and taken over. They are the 33rd largest institution in total derivatives value, and the second largest in United States history to go bankrupt, to go defunct. And well, let's just say that all of this exposure to these derivatives is rehypothecated and shared amongst almost every single one of these other institutions. Not to mention all the corporations that are going to take a hit to that 91% of that 180 billion that is not insured and covered by the FDIC. In addition, we knew that Jim Cramer was pumping this stock. We can see that they're absolutely massive, and the CEO has been selling off shares of stock of SIVB for almost 2 weeks. Guess who are the majority owners of these? Vanguard Group, SSGA Funds Management, BlackRock, Electa Pension, JP Morgan, Artisan Partners, Geode Capital, and mutual funds? Vanguard, JP Morgan, the S&P 500 ETF Trust, the SPY, Fidelity 500 Index Fund, Fidelity, the government pension funds. Of course, average Americans are going to take a massive loss on their 401k, pensions, IRAs, thrift savings plans, ISAs, you name it, and people around the world, Canadians, Europeans, stock market investors in general. Then you can see the Vanguard Total Stock Market Index Fund, their mid cap, and their 500 Index Fund, JP Morgan's Large Cap Growth Fund, the S&P 500 ETF, the SPY, the Fidelity 500 Index Fund, and the government pension funds all own 1 to 3% of that company at the moment. Ladies and gentlemen, bank runs are upon us. This is just the beginning of what is to get a lot more serious. And they were the 16th largest United States bank out of all United States banks. It said 88% of Forbes 2022 Next Billion-Dollar Startups are SVB clients. 88% of Forbes 2022 Next Billion-Dollar Startups were SVB clients. 50% of all U.S. venture capital-backed tech and life science companies banked with SVB. Half of all venture capital-backed tech and life science companies. 44% of all United States venture capital-backed companies with an IPO in 2022 were SVB clients. Almost half of IPOs that were venture capital-backed in 2022 were banking with SVB. Today, we saw other banks like First Republic Bank was down 21%. Signature Bank was down 21%. First Republic was down 31%. And Silicon Valley was down 62% earlier today. Some of them have regained some of their losses, but it is probably going to get worse before it gets better. Let's say that much. And perhaps more problematically, SVB's bonds are collapsing. Bonds have not been halted. The stock is halted, but bonds in SVB have not been halted, and they are extending losses after the halt occurred. They're down an additional, looks like to be about 10% after the halts, and could be probably even worse at this point. The fears of SVB's collapse is a contagion that has been dragging down Western Alliance, Charles Schwab, and First Republic Bank. The same CEO that sold off $3.57 million worth of his stock over the last couple weeks yesterday advised clients to stay calm and amidst concerns of their decision. Obviously, this guy's not staying calm. He just sold off over $3.5 million worth of shares, and if he had more, he'd probably sell those off. He probably would have sold those too. And the fact of the matter is this, that things have been breaking in the past 2 days. First Republic Bank, based in San Francisco, plummeted 16.5% yesterday and 15% today. Phoenix Bank, Western Alliance Bancorp lost 35% and is now trading around $49 a share. Signature Bank fell more than 21% to a 52-week low of $82 a share. Salt Lake City's based Zions Bancorp fell more than 13% to a 52-week low, $40 a share. Pasadena's East West Bancorp shares were down 12% to $64. And Minneapolis's U.S. Bancorp lost $7 a share, 7%, to close at $42 a share. And one of the prevailing themes is that the Federal Reserve has been trapped by their very own mandates to fight inflation and maintain high employment. Today's job creation numbers came in hotter than expected. Of course, rate hikes have never been accelerated so high in such a short duration in history. And critics of the policy state that the Fed is going to keep hiking until they break something. Ladies and gentlemen, if you've been watching this channel for any extended period of time, you know that's exactly what we've been fucking saying since January of 2021, when nobody thought the stock market was going to go lower, when everybody thought that it was going to roar to 500 on the SPY. I told you that was not going to fucking happen. Before everybody called it last year, we were telling you here that CPI was out of control, that inflation was out of control, and hyperinflation is here to stay. We were saying this in the middle of 2021. In the middle of 2021, before January 2022, stocks started actually collapsing. And this whole little shell game that we've had so far has continued. Now, what else is available out there? What is out there that is not a bank that could be a possible store of gold? Gold and silver could be a possible very good store of wealth. I'm not a financial advisor, and this is not financial advice. You should do your own due diligence. This is just facts that in the past, during 2008 and other times, we've seen precious metals do very well. Returning to fundamentals can be crucial in risk management. See, the thing about banks is that deposits are liability owed by the bank to the depositor, because as soon as you put your money in the bank, they get placed and invested immediately. Bank deposits refer to this liability rather than the actual funds that have been deposited, and that's what's going on with SIVB. They don't have $180 billion, $190 billion to repay all of the debtors, the people that are owed, creditors. For example, when someone opens a bank account and makes a cash deposit, you surrender your legal title to the cash, and it becomes an asset of the bank. In turn, the account is a liability to the bank as that asset is immediately invested. By contrast, gold and silver do not have these counterparty risk problems when invested in physical metals. They're premier asset classes around the world. Silver is not only a primary monetary metal, but also an industrial metal. It has been underperforming the market, much like oil, and has been heavily shorted by the largest institutions out there that over-leverage themselves in derivatives like JP Morgan, Goldman, Citibank, Bank of America, and of the very own Silicon Valley. The market believes a recession will diminish demand for silver in consumer products, but I think it's all the opposite. Increased demand for wind, solar, electric vehicles, batteries, renewables, all of these applications are using massive amounts of silver. Silver's cost of production puts a floor on the price, which doesn't happen with stocks. Even though the actual price itself is manipulated, there is a stronger floor due to the requirements and need for silver in industry. It's extremely close to the production price, so it does have limited downside. Now, again, I'm not a financial advisor, and this is not financial advice. You should not go out and buy gold and silver just because I said so. You should do your own homework and your own due diligence on it. But there's an enormous gap between the price of gold relative to that of silver. And historically, silver makes giant leaps close to this gap whenever there have been issues in the past, like in 2008 and such. Silver technically, percentage-wise, outperforms gold to the upside, just like it underperformed recently to the downside. And central banks around the world are buying up record amounts of gold and silver, as we've shown you on this channel as well. The U.S. government spent $6.27 trillion of total revenues of $4.9 trillion last year. That's a deficit of $1.38 trillion that had to be borrowed into existence. And that does not account for the $1.7 trillion omnibus spending spree. This doesn't count all the emergency aid to Ukraine, which is now over $140 billion fucking dollars. Banks are coming under significant pressure. The Fed may be forced to rev up the money printers again, QE into infinity. Congress and the Fed could be forced to step in, and you may hear these two words: bailouts. Then interest rates are likely to be reduced to stimulate the economy, and gold and silver will shine in the darkness. Huge shout out to Money Metals Exchange. I do enjoy them. I'm not sponsored in any way, but I do enjoy their content, and I enjoy making purchases from there as well as other places. I'd like to say thank you to everybody for your support here of the think tank. This is going to get a whole lot worse before it gets better. And I can't wait to watch this shit burn. It's way overdue. On that note, I'm going to leave you with that because I don't want this video to get too long. I wish you peace and wealth. Invest wisely. Save wisely. Invest in tangible assets and goods. And make sure you practice. Practice, practice, practice. Grow your own food. And do everything necessary to make sure that your family is safe. Thank you, everybody. Have a great day. I appreciate you. Gonna be so goddamn rich.
I think it's time to blow this scene. Get everybody in the stuff together. Okay, 3, 2, 1, let's go.
Gonna be fucking rich. I want my fucking money. Griffin, I want my fucking money. Yo, motherfucker. Holy shit, we're so fucking rich.
Oh yeah.
Great. Damn it, we're gonna be so fucking rich. Properly hedged is the way to go. I'm hedged for this fucking collapse, that's for sure. sounds that money printer made.
Listen, I want my fucking money.
You're an original,
Hey,
aren't
yelling,
you?
I need the fucking money.
It sounds like 18% because it's going overtime.
Get the goddamn money printer out.
Great. Bounty letter.
We're gonna be so fucking rich. Get the goddamn money printer out.